Okay, so I'm giving you the lecture of the series what we had started earlier of financial accounting, and this is the third chapter of that series. So here we are going to discuss the main part and the substantial part of the accounting cycle, that is accruals and deferrals. So for most companies, the revenues is not always earned as cash is received, nor is an expense necessarily incurred as cash is disbursed. Timing differences between cash flows and the recognition of revenue and expenses are referred to as accruals and deferrals. In this lecture, we examine how accounting information must be adjusted for accruals and deferrals prior to the preparation of financial statements. The first three steps of the accounting cycle were discussed in the previous lectures. They include recording transactions, posting transactions, and preparing a trial balance. In this lecture, we focus solely upon the fourth step of the accounting cycle, performing the end of period adjustment required to measure business income. The remaining steps of the cycle are covered in the upcoming videos. So you can see that when we are going to talk about the adjusting entries, there is more to the measurement of the business income and merely recording simple revenue and expense transactions that affect only a single accounting period. Certain transactions affect the revenue or expenses of two or more accounting periods. The purpose of adjusting entry is to assign to each accounting period appropriate amounts of revenue and expense. For example, a firm purchased shop supplies that will be used for several months. Thus, an adjusting entry is required to record the expense associated with the shop supplies that firm uses each month. So the question arises, what is the need for adjusting entry? And when do we need to adjust the account? So usually at the end of period, we need to make adjusting entries to get the accounts up to date for the financial statements. So for purposes of measuring income and preparing financial statements, the life of business is divided into a series of accounting periods. This practice enables decision makers to compare the financial statement of successive periods and to identify significant trends. But measuring net income for a relatively short accounting period, such as a month or even a year, poses a problem because, as mentioned above, some business activities affect the revenue and expenses for multiple accounting periods. Therefore, adjusting entries are needed at the end of each accounting period to make certain that appropriate amounts of revenue and expense are reported in the company's income statement. For example, magazine publishers often sell 2 or 3 year subscription to their publications. So, at the end of each accounting period, the publisher make adjusting entries recognizing the portion of their advance receipts that have been earned during the current period. Most companies also purchase insurance policy that benefits more than one period. Therefore, an adjusting entry is needed to make certain that an appropriate portion of each policy's total cost is reported in the income statement as insurance expense for the period. In short, adjusting entries are needed whenever transactions affect the revenue or expenses of more than one accounting period. These entries assign revenues to the period in which they are earned and expenses to the period in which related goods and services are used. So here you can see that adjusting entries are needed whenever revenue or expenses affect more than one accounting period, and every adjusting entry involves a change in either a revenue or expense and an asset or liability. So the types of adjusting entry. So here you can see there are 4 types of adjusting entry. The number of adjustment needed to end of each accounting period depends entirely upon the nature of company's business activity. However, most adjusting entries fall into one of the 4 general categories. Number 1 is converting assets to expense. Here, a cash expenditure that will benefit more than one accounting period usually is recorded by debiting an asset account, for example, supplies, prepaid insurance, and so on, and by crediting the cash. So the asset account created annually represents the deferral or the postponement of an expense in each future period that benefits from the use of this asset. An adjusting entry is made to allocate a portion of the asset's cost from the balance sheet to the income statement as an expense. That how much proportion of that expense is used up. So that means the asset is turning to expense account. So that means the proportion of an asset, like the adjusting entry is recorded by debiting the appropriate expense account, for example, supplies expense or insurance expense, and credited the related asset account, for example, supplies and prepaid insurance. In other part, that is converting liabilities to revenue. So in converting liabilities to revenue, a business may collect cash in advance for services to be rendered in future accounting periods. So transactions of this nature are usually recorded by debiting cash and by crediting a liability amount. So typically called unearned revenue or deferred revenue. Here, this liability account created represents the deferral or the postponement of a revenue in this period that services are actually rendered or that goods are sold. An adjusting entry is made to allocate a portion of the liability from the balance sheet to the income statement to recognize the revenue earned during the period. So the adjusting entry is recorded by debiting the liability, that is unearned revenue, and by crediting the revenue earned on a similar account for the value of the service. So in the third type of the adjusting entry, that is accruing unpaid expenses. So here, an expense may be incurred in the current accounting period even though no cash payment will occur until a future period. These accrued expenses are recorded by an adjusting entry made at the end of each end of each accounting period. The adjusting entry is recorded by debiting the appropriate expense account, for example, interest expense or salary expense, and by crediting the related liability, for example, interest payable and salaries payable. Similarly, the last one is accruing uncollected revenue. So here you can see that the revenue may be earned or accrued during the current period even though the collection of cash will not occur until a future period. I mean unrecorded earned revenue for which no cash has been received requires an adjusting entry at the end of the accounting period. The adjusting entry is recorded by debiting an appropriate asset, for example, account receivable or interest receivable, and by crediting the appropriate account or revenue account. For example, service revenue earned or the interest earned. So here, if we are going to summarize this slide, so you can say that the first two, that is 1 and 2, are the deferral account, and the next two are the accrual accounts. The deferral account means that, like converting assets to expense, so that means initially you have to pass a business transaction, and this then you need to adjust at the end of that accounting period. Similarly, that the asset is going to expense, that means you have made a prepaid amount in advance, and now this amount of money is slowly and gradually, I mean fractionally, it is turning to the expense account. In the converting liabilities to revenue account, that means you have paid, you have received an amount in advance, and this amount will be slowly and gradually become earned. So that means this is the amount of money paid in advance, and it is initially converted into cash, and then cash will be fractionally, or a portion of the portion of the asset that turns to expense will be recorded as an adjusting entry. Here, the converting liabilities to revenue means that you have received the money in advance and the services are not rendered yet. So whenever the services will be rendered, your liability or your unearned revenue will start to realize, and then the revenue will be incurred. Third entry and the fourth entry, that is accruing unpaid expenses. So in the accruing unpaid expenses, you could say that the transaction will be passed after the adjusting entry. That means, say for example, at the end of the period you are realizing that the expense is incurred but the amount has not been paid. So in that situation, what you will do is that you will pass the entry, that is, let's suppose salaries expense debit and salaries payable credit, and whenever the transaction will be occurred, that whenever you will pay the cash for that, so you will record the entry, that is, the cash is the salaries payable is debit and cash is credit. And in accruing uncollected revenues, so here the revenue has been received afterwards. So that means the services are rendered, but you could say that the services are rendered but the cash is not received, so it is your account receivable or something. So adjusting entries and the timing difference. Now, in an accrual accounting system, there are timing differences between cash flows and the recognition of expenses or revenue. A company can pay cash in advance of incurring certain expenses or receive cash before revenue has been earned. Likewise, it can incur certain expenses before paying any cash, or it can earn revenue before any cash is received. So these timing differences and the adjusting entries that results from them as are summarized below. So adjusting entries to convert asset to expense result from cash being paid prior to an expense being incurred. Adjusting entries to convert liabilities to revenue result from cash being received prior to revenue being earned. Or adjusting entries to accrue unpaid expenses result from the expenses being incurred before cash is paid. And adjusting entries to accrue uncollected revenue result from revenue being earned before cash is received. So, as illustrated, adjusting entries provide important linkages between accounting periods related to these time differences, especially the link prior period cash outflows to current period expenses. Similarly, prior period cash inflows to current period revenue, or say current period expenses to future cash outflows, or current period revenue to future cash inflows. So now you can see that converting assets to expense. So here we are taking the example of the first type of the adjusting entry, and that is basically that converting assets to expense. So we have broken down the adjusting entry into three periods. One is the prior period, other is the current period, and the future period. So the business transaction, let's say for example, paid future expense in advance. So that means when you are going to pay some amount of money in advance, so initially it will be considered or recorded as a current asset. And the reason is because it is not used up yet. So according to matching principle, which we had discussed earlier in the previous lectures, so you understand that you have to follow the matching principle of expenses. So the expense is not incurred yet and we have paid the amount of money in advance, right? So keeping in mind two important characteristics of all adjusting entry. First, every adjusting entry involves the recognition of either revenue or expenses. So revenue and expense represents changes in the owner's equity, and however owner's equity cannot change by itself, they also must be corresponding change in either assets or liabilities. So thus every adjusting entry affects both an income statement account, or revenue or expense account, and the balance sheet account, that is assets or liabilities. Rarely do adjusting entries include an entry to cash. The second thing which you have to keep in mind is that adjusting entries are based on the concept of accrual accounting, not upon monthly bills or month-end transactions. So no one sends, say for example, a bill saying shop supply expense for the month, it's, let's say for example, $500, yet like must be aware of the need of to record the estimated cost of shop supplies or anything consumed if it is measure income properly for the period. Making adjusting entry requires a greater understanding of accrual accounting concept and thus the recording of routine business transactions. So, as we were discussing, converting assets to expense, when a business make an expenditure that will benefit more than one accounting period, the amount usually is debited to an asset account. At the end of each period, benefiting from the expenditure, an adjusting entry is made to transfer an appropriate.
Thanks for watching. For new video updates, press subscribe button so you will notified.